every stock market term you need to actually start investing. Stock, share, and shareholder. Stock represents ownership in a company. When you buy Apple stock, you're not buying some abstract number that goes up and down. You literally own a tiny piece of Apple. Each unit is called a share. If Apple has 1 billion shares and you own one, you own 1/1000th of the company. Congratulations! You're technically Tim Cook's business partner. That makes you a shareholder. That's it. Own 1 share, shareholder. Own 1 million, still a shareholder. It's not that deep. Private company, an IPO. Not every company lets random people buy their stock, though. A public company is one whose shares you can buy on the open market. Apple, Microsoft, Tesla, all public. You can buy them on Robinhood right now if you want. Private companies are the opposite. SpaceX is private. You can't just buy SpaceX stock. Elon has to personally approve you. And spoiler alert, he won't. When a private company becomes public, they do an IPO, initial public offering. This is when they first sell shares to regular people to raise money. Facebook did this in 2012. Uber in 2019. It's the moment you can finally throw your money at them. Stock exchange and broker. You can't walk up to Apple headquarters and ask to buy shares. Everything happens through stock exchanges. Think of it like eBay, but instead of used furniture, you're trading pieces of companies. The 2 big ones in America are the New York Stock Exchange and NASDAQ. Different companies list in different exchanges, but as a regular person, you don't need to care which is which. Here's the problem. You can't directly access these exchanges. You need a broker. A broker is a platform that connects you to the stock market. Robinhood, Fidelity, Charles Schwab, Interactive Brokers, these are all brokers. They execute your trades for you. Brokerage account, portfolio, and holdings. When you open an account with Robinhood, you're creating a brokerage account. It's like a bank account, but for investing. You deposit money, then use that money to buy stocks. All your investments together are called your portfolio. The individual stocks you own are your holdings. If you own Apple, Tesla, and Microsoft, that's your portfolio. Not impressive, but it's yours. Ticker symbol. Every stock has a ticker symbol, which is just a short code to identify it. Apple is AAPL. Tesla is TSLA. Microsoft is MSFT. When you search on Robinhood, you type this in. Bull market and bear market. Sometimes the whole market moves together. When most stocks are rising over time, that's a bull market. Bulls thrust upward with their horns. When most are falling, that's a bear market. Bears swipe down with their paws. Now you'll never forget. Bid-ask and bid-ask spread. When you look at a stock price, you're seeing what the last person paid for it. But right now, there are people trying to buy and people trying to sell. The bid is the highest price someone will pay to buy right now. The ask is the lowest price someone will sell for. If Apple has a bid of $150 and an ask of $150.05, someone will buy at $150. Someone will sell at $150.05. The difference is called the bid-ask spread. For popular stocks like Apple, the spread is tiny, maybe a few cents. For sketchy penny stocks nobody wants, it can be massive. Volume and liquidity. Volume is how many shares trade in a day. High volume means lots of action, which means high liquidity. Liquidity is how easily you can buy or sell. High liquidity means you can trade whenever you want. Low liquidity means you might be stuck waiting for someone to take the other side of your trade. Not fun. Volatility. Stock prices jump around constantly. Volatility measures how much. High volatility means the price might go up 5% one day and down 6% the next. Low volatility means it's boring and stable. Boring is underrated. Market order and limit order. You've got money in your brokerage account. You found a stock you want. Now you need to actually buy it, and there are different ways. The simplest is a market order. You're saying, buy this stock right now at whatever the current price is. If Apple is at $150, you'll get it around $150. Market orders execute instantly. The downside, you don't control the exact price. If the stock is moving fast, you might pay more than you thought. A limit order is different. You specify the exact price you'll pay. I'll buy Apple, but only at $148 or less. If it never hits $148, your order doesn't fill. But if it does, you got exactly the price you wanted. Which one should you use? For beginners buying normal stocks like Apple, market orders are fine. The price won't change much in the 2 seconds it takes to execute. But if you want to control or you're buying something sketchy, use limit orders. Fractional shares. You also need to decide how many shares. If Apple costs $150 and you have $1,500, you can buy 10 shares. Some brokers now let you buy fractional shares, meaning you can buy 0.33 shares if you only have $50. This is great for expensive stocks like Amazon. After you buy, the shares just sit in your account. You own them. You can hold for decades or sell tomorrow. Up to you. Capital gains, capital loss, and dividends. There are 2 ways to make money from stocks. First way, buy low, sell high. You buy Apple at $150, it goes up to $200. You sell. You made $50 per share. The profit is called a capital gain. If you sell for less than you paid, that's a capital loss. Try to avoid those. When you sell, you use the same order types. Market order to sell instantly, or limit order to sell only at your target price. Second way, dividends. Some companies pay cash to shareholders just for owning the stock. If you own 100 shares of a company paying $2 per share annually, you get $200 per year for doing nothing. Not every company pays dividends though. Tesla and Amazon don't because they reinvest everything to grow. But older companies like Coca-Cola and Johnson & Johnson do. Dividends usually pay quarterly. The money just appears in your account automatically. Market cap. Before throwing money at random stocks, you should know how to evaluate what you're buying. Market cap tells you how big a company is. You calculate it by multiplying stock price times total shares. If a company has 1 billion shares at $50 each, market cap is $50 billion. Companies are grouped as large cap, over 10 billion, mid cap, 2 to 10 billion, and small cap, under 2 billion. Bigger companies are usually safer but grow slower. Smaller companies are riskier with more growth potential. Earnings per share and PE ratio. Earnings per share shows profit per share. If a company earned $5 billion and has 1 billion shares, EPS is $5. Higher EPS generally means more profitable. The PE ratio compares stock price to earnings per share. If a stock costs $100 and earns $5 per share, PE is 20. This tells you how much you're paying for each dollar of earnings. High PE might mean overvalued or high growth expectations. Low PE might mean undervalued or the company has problems. Context matters. Blue chip stocks. Blue chip stocks are well-known established companies. Apple, Microsoft, Coca-Cola. They're generally safer but won't explode in value overnight. They're the boring choice that actually works. Stop loss order. Investing has risk. Prices go down. You can lose money, but there are tools to manage this. A stop loss order automatically sells if a stock drops to a certain price. You buy Apple at $150, but don't want to lose more than 10%. Set a stop loss at $135. If it hits $135, it sells automatically, limiting your loss. The problem? Sometimes stocks dip temporarily, then recover. You might get stopped out right before it bounces back. Frustrating, but that's the trade-off. Diversification. Diversification means spreading money across different stocks instead of one. Put everything in one stock and it crashes, you're screwed. Own 20 different stocks and one crashes, you only lose 5% of your portfolio. Don't put all your eggs in one basket. Your grandma was right. ETF, index, and index fund. The easiest way to diversify is through ETFs, exchange-traded funds. An ETF is a basket of many stocks that trades like a single stock. The most popular is SPY, which tracks the S&P 500. The S&P 500 is an index of the 500 largest US companies. Buy one share of SPY, you own tiny pieces of all 500. Instant diversification. Index funds are similar. They're mutual funds tracking an index. The main difference is technical. ETFs trade all day, like stocks. Mutual funds only trade at the end of the day. For beginners, ETFs are simpler. Going long, long-term investing, day trading, and swing trading. There are different ways to invest, and your strategy matters. Going long means you expect the price to increase, so you buy and hold. This is normal investing. Buy Apple today, hold for years, hopefully it's worth more later. Long-term investing means holding for years or decades. This is what financial advisors recommend. The stock market historically goes up over long periods, despite crashes. Buy an S&P 500 fund 20 years ago and hold, you tripled your money, even though 2008 and 2020 crashes. Day trading is the opposite. Buy and sell within the same day, trying to profit from tiny movements. Sounds exciting. It's actually just a good way to lose money. Most day traders fail. It requires constant attention and honestly, don't do it. Swing trading is in between. Hold for days or weeks. Still risky, still needs knowledge. For most people starting out, long-term investing in ETFs is smartest. It's boring. It works. Pick one. Capital gains tax and IRA. When you make money, you owe taxes and gains. Sell a stock for more than you paid, capital gains tax. Hold less than a year, short-term capital gains taxed at your normal income rate. Could be 20 to 30% or more. Hold more than a year, long-term capital gains, much lower, usually 0%, 15%, or 20%, depending on income. This is why long-term investing is better. One way to invest tax-free is through an IRA, individual retirement account. With a Roth IRA, you pay taxes now, but gains grow tax-free forever. You can't touch it until retirement without penalties, but it's powerful for long-term wealth. Shorting and short squeeze. Once you start, you'll hear people mention advanced strategies. You don't need to use them, but you should know what they mean. Shorting is betting a stock goes down. You borrow shares, sell them, then buy them back cheaper later to return them. If you're right, you profit. If you're wrong, you lose money. And unlike normal investing where you can only lose what you put in, shorting has unlimited loss potential. The stock can go up forever. You can lose forever. This is for experts only. A short squeeze happens when a heavily shorted stock suddenly spikes. All the short sellers buy back shares to cut losses, pushing the price higher. GameStop 2021 was a massive short squeeze that destroyed hedge funds. Options and leverage. Options are contracts giving you the right, but not obligation to buy or sell at a specific price by a specific date. Call options bet on up. Put options bet on down. They're complex and risky. Avoid them until you know what you're doing. Leverage means borrowing money to invest. Some brokers let you trade on margin, meaning borrow money to buy more stocks than you can afford. This amplifies gains and losses. If you're wrong, you lose more than you put in. Stay away from this. Panic selling and dollar cost averaging. Don't panic sell. When the market crashes and your stocks drop 20%, your instinct is to sell everything. But this locks in losses. The market always recovers if you wait. People who panic sold during COVID 2020 missed the massive recovery. Don't try to time the market. Nobody can consistently predict tops and bottoms. People who try usually fail. It's better to use dollar cost averaging. Invest the same amount regularly, like $500 every month, regardless of price. Sometimes you buy high, sometimes low. It averages out. Pump and dump. Pump and dump is a form of fraud, where someone artificially inflates a stock's price through false hype and misleading statements. They pump up the price so they can dump their shares at the peak. Once they sell, the price crashes and everyone else loses money. This usually happens with penny stocks and small cryptocurrencies. If someone on social media is aggressively promoting a stock and promising huge returns, they're probably running a pump and dump scheme. Run away. If you guys found this helpful and want more investing content, leave a like or comment. Thank you guys so much for watching. And as always, ciao.